there's a lot of things just in your business. And I think people get distracted by that and they don't calculate how much work is that going to take and what is that going to return to me. So always be thinking about what's your return on hustle.
This podcast is for educational purposes only. Nothing you hear on this show is legal or investment advice, nor is it an offer to buy or sell securities. Always consult your own legal and financial professionals before making decisions.
Welcome back to another Capital Flow podcast. My name is Dallon Schultz. I'll be your host. We got Paul over here on the cameras. Got a super exciting guest with us today. If this is your first time tuning in, if you're looking to raise $100,000 or more from a single investor, this is the show for you. Every single one of our guests has either raised millions of dollars or are a service provider to help you in that journey. And that's who we've got today, Mr. Mat Sorensen. Thanks for coming in.
Yeah, thanks so much, Dallon, for coming out. I know you've been to my studio. I appreciate it. I get to come to yours this time. It's pretty nice, I have to say. And but I love talking about raising capital, and I love talking about the number one untapped resource for it. I'm just telling you, if you don't know this and aren't using this strategy, you are leaving millions, if not tens of millions of dollars on the table in your fund. It sounds boring.
It's not.
Because it's IRAs and 401ks and retirement accounts, and a lot of people get bored by that. But if you don't know this strategy, or you've heard it before, I want you to hang with me here for a second because I want to talk about how to actually use it right. Because I got a lot of good examples I think I can give.
Yeah, absolutely, and I can attest to that. As in our journey of raising capital, we've easily raised high six-digit investors just from what we're about to talk about today. Like it's insane. And so there's actually an example I'll share here in a little bit. But Matt, share with our listeners a little bit about who you are and how you got to where you are today.
Yeah, sure. So I started my career as a lawyer, business and tax lawyer. I have a partner, Mark J. Kohler. We have a business and tax law firm in 4 states and 60 plus employees representing clients across the country, but I don't do that anymore. So I pretty much just bring in some business to it. But what I did as a lawyer is I helped clients learn how to use their retirement accounts, their IRA accounts mostly, or old 401ks, and how can I invest that in real estate? And that was just a fascinating subject to me. I didn't really know much about it. They don't teach it in law school. It's not on the bar exam, but I dove deep into it because we had a lot of clients, business owners, investors, entrepreneurs that were like, I don't want to go buy another mutual fund with my IRA or 401k. I want to invest in a small business or a real estate deal. And how can I do that with my retirement account? And so we learned the strategies and how to do that. And I kind of became an expert as a lawyer. So I ended up writing the number one book in the field on it called the Self-Directed IRA Handbook. Pretty much every company in the industry now, every bank or trust company that does these self-directed IRAs we'll talk about uses my book to train their employees. The National Association in the industry uses my book to train their employees. And I say this just so you know, like, I'm very good at this. Like, I know everything in this subject. Outside of this, I'm pretty average, okay? But in this thing, like, I became like the expert in the field. What happened though as a lawyer is I started sending all my clients, all these companies in the industry, and I was like, you guys suck at helping clients actually do this. And so I started my own company. So that's called Directed IRA. We're a trust company, but we're here in Phoenix. And what we do at Directed IRA is we handle the IRA account. So think of like Charles Schwab. Someone opens up their IRA at Charles Schwab and they're like, all right, what can I invest in? Well, Charles Schwab's a broker dealer. So you can invest in what broker dealers sell, which is stocks, bonds, and mutual funds. But when you have an IRA with us at Directed IRA, what we let you do is invest in real estate, invest in a private fund, invest in a startup or a private equity fund or crypto or precious metals, whatever you want to do, you know? And so we started that really in 2019 was when we started taking accounts. And now, you know, we're at 20,000 accounts, $2.5 billion in assets nearly, and are growing very quickly because people want to know how they can invest their money off the stock market. A lot of people feel over-invested in the stock market, not attached to it. If they have an investment in their IRA, like a mutual fund or an ETF, they don't even know what that is and what it actually owns. Like what does that mutual fund actually own? And so they're just got a lot disconnected from their dollars. So people are excited about it. I think there's a ton of opportunity in it. But one thing people need is an alternative investment opportunity.
100%. And what I didn't share with our listeners, we use Directed
Yeah.
IRA. Like, we use you guys. So super excited to have you be in here with us. It is a secret tool for raising capital. And it's something that we've really been leaning into. And we had this situation with a specific investor last year, and he loved our opportunity. Loved the opportunity. He had about 150K sitting there. He wanted to invest, and he was torn because for years, him and his wife were wanting to buy a family cabin, and there was one on the market. So they're looking at these two opportunities. It's like, do we buy a family cabin and make memories, or do we invest in this good opportunity and continue growing and preserving our wealth? And so having a conversation with them and just exploring options, the idea or the concept of self-directed IRAs came up, and he's like, what do you mean? We're like, yeah, if you're, and he happened to be self-employed, there's some conditions that we can have you touch on here in a little bit. Long story short, he qualified for a self-directed IRA.
Yeah.
So he moved some funds over to a self-directed IRA, used their cash to buy the family cabin, and still got to participate in our investment opportunity. And that's when it, like, I knew of self-directed IRAs. We helped people set it up before, but like, that was a situation where somebody could have their cake and eat it too.
Yeah.
And I was like, this is incredible.
Yeah. And I think just so everybody understands, this self-directed IRA concept is, all the self-directed IRA is it's an IRA at a company like Directed IRA, our company, where we're going to say you can invest it whenever you want. I'm not going to make you buy a stock bond or a mutual fund.
You're not advisors.
Yeah, we're not advisors. You pick what you want to invest it in, but we'll let you invest in real estate, in a private fund, and in non-publicly traded assets. So now when most people come to us because their IRAs already sitting over at Schwab or Fidelity or Vanguard, or they got an old employer 401k, and they're usually rolling over dollars. And that's really important, because if you're raising capital, the number one question you should be asking is, do you have money in an IRA or 401k? Yes or no? I'm just telling you, the answer you're going to get is yes. Most Americans do. The average account balance is over $100,000. The average American's IRA or 401k account balance. Okay, just so you put this in context, there is $40 trillion in U.S. retirement accounts. Like, there's more money there than anywhere. And the people you're already talking to raise capital from, you're not even asking the question of where most of their money is, because you're not even thinking about it. So you got to ask that freaking question of, do you have money in IRA or 401k? Yes, I do. Are you getting better than 10% return? Typically their answer is going to be, I don't know, or no. It's rare you're going to get, yes, I'm doing very well. It's usually, I don't know, or no. And then it's like, well, here's what we're doing, and we're projecting this type of return, whatever your opportunity might be. And so wouldn't you rather grow your retirement account over here and have double the account when you hit 59 and a half? That's twice the size of it, then keep investing in this mutual fund you don't even know what it is and is getting you a crappy return. So then you can get in that conversation. And so now here's what happens. Let's say they're at Charles Schwab and they're like, all right, well, cool, I want to do this, Dallon, but I called up Charles Schwab and they said I can't invest in your deal. Well, that's not because IRAs can't do it. That's because Schwab IRAs can't do it. They're a broker-dealer. They sell broker-dealer product. So you need to move it.
And they don't want to move it because now you're moving funds out of their management, assets under management.
Schwab doesn't, and if they have a financial advisor, the financial advisor is like, well, I don't know, this could be risky.
That's risky. You're going to lose your...
Yeah, the subtext of that is, I'm losing this money under management. If you move $100,000 and I'm charging you a 2% or a 1% management fee, that I just lost $1,000 in annual, fees from you. So there's, just be careful. You got some interested people that might give you some different advice, but a lot of people don't have an advisor, right? They're just going to be, well, if I want to move it and I'm at Schwab, and you could have a $500,000 account there and be like, well, I want to invest $100,000 in this opportunity. Just transfer over $100,000.
Yeah, you don't need to do all of it.
Yeah, this could be your traditional IRA at Schwab. It could be your Roth IRA. We can do a Roth IRA, Directed IRA, traditional IRA, SEP IRA. And so you can just move that money over. And that's the most common thing, is most people, they already have an IRA. And so when I drop that number of $40 trillion, like that $40 trillion, a lot of people think most of the retirement account dollars are in 401ks. It's actually not. The number one largest category of retirement accounts of the 40 trillion is already IRAs. Because most people have had an old employer 401k, they've already rolled into an IRA at Fidelity or Schwab or wherever it's at. And so most of the money is already sitting in IRAs, and that's very easy to just move over. And so like that person that was like struggling with that concept of, I've got this investable amount of money. Do I do the fun thing, or do I invest it in the smart investment? You know, do I do the cabin or the new car, or, you know, pay for all my kids' college, you know, or whatever. These are real things, you know, investors are thinking about. Or do I invest in this great investment opportunity I just heard about? Well, if you talk about their IRA or 401k, they're not thinking about buying a cabin with it, paying for their kids' college. They can't use it for that. Yep. It's locked down long-term wealth building. I'm just telling you, it's the easiest money to get because 100%. They've already set it aside in their brain to invest and not touch until they're 60.
100%. And we're talking about a lot of stuff here. And to our listener, if this is your first time hearing about self-directed IRAs, you might start feeling a little overwhelmed. Here's the deal. Matt and his team make it stupid easy. Like, as long as you're aware of what this is, like for our investors, we're plugged in the space. We have maybe have a little bit more understanding than somebody on this process. But either way, we share with them enough for them to be like, yeah, that sounds interesting. And then we just connect them with your team. And then your team education handles it from there at a very affordable price. Like, we've had no complaints from our people with the way you guys have been handling things. And for people that are raising capital, Matt touched on this. Talking to somebody about retirement funds versus cash in their hand. If you're asking someone to part with $100,000 cash, they're much more emotionally tied to that. But if it's $100,000 sitting in a retirement account that they're like, oh, I'm not touching that for another 20 years, but they're still not happy with how it's performing, or they don't know, or they want more control, then you have this simple conversation with them. They move it over. Now you got that $100,000 for your next investment. It's a freaking it's an incredible tool that I don't think is talked about and utilized as much as it should be.
Yeah, I was talking to a syndicator. I won't mention their name, but they're pretty well known. They did a raise about a year ago. 90% of the money they raised was from IRAs and 401ks because they talked about it when they went out and raised the capital. And they're like, wow, we didn't realize how easy that was. You know, there was a steps, right? It's like you need to go set up the self-directed IRA, and that's we love that, of course, because we open accounts. That's our business. But I'm like, but that's what our team does. And so you don't need to have like an expert on your team on IRAs. You just need to have anyone on your investor relations team that's having those capital raising conversations to know. Ask that question. Do you have money in an IRA or 401k? Did you know you could invest IRA or 401k dollars into our deal? And these are the returns, and that helps build up your retirement account. This is your long-term wealth building. It's a really powerful concept. And so, you know, what's happening actually on the institutional side, the big private equity firms are all starting to do this right now. Yeah, we're getting pretty big relationships. They want to do this because what they're doing now, the big private equity funds, you know, you'll hear like Carlyle talk about this, KKR right now. They're talking about raising from the mass affluent. Okay, that's what they call the mass affluent. This is kind of like everyday Americans that have money, basically. This is not the ultra high net worth people that have 100 million or 50 million or more that they typically have raised capital from. So they're like, we want to raise capital from the mass affluent. And what they've realized is, oh, most of their money to invest is in their IRA or 401k, so we better figure this out. So they're doing that right now. Mm-hmm. And, but again, the reason I mention that is that's where the money is. So if you think of who you're investing, if you're raising capital from, if you're raising capital from family offices and sovereign wealth funds and other places like that, you don't talk about this. But if you're raising money from people you know, like your friend down the street, your aunt or uncle, or like your friend from your church, or that you golf with, or you do yoga with, or whatever, it's like, it's just most likely that most everyday Americans, the mass affluent out there that have investable money, it's in their IRA or 401k. And so I think you get to yes, and we'll raise more capital being knowledgeable about that.
And we speak heavily on when you're raising capital. And first of all, we like to refer to it as attracting capital. It shifts a different mindset. But when you're attracting capital, setting yourself up as a guide, you're the investor, they're the hero in their own journey. Mm-hmm. You're the guide to help them along that path. Having this tool in our tool belt of ways to serve our clients has been incredible. And most people don't know about it. They don't even know that it's an option. And I think that's by design by some of these big broker dealers and big institutional investment firms. But what I appreciate about you guys and other syndicators and others raising capitals, we're trying to change that. We're trying to bring the power back to the everyday American. People that are making maybe a low to mid 6-digit salary. They've got a few $100,000 sitting there in a retirement account, and they realize I don't have enough to retire in 15, 20 years. And so they're the ones that are starting to look at different ways, better ways to improve that situation. And so that can be easily accomplished through these self-directed IRAs.
Yeah. And I think it's exciting because it's where the money's at. I think it's easily attainable once you understand just the process and rules, and really that is connecting with directed IRA. And there's other companies that do what we do. They're just not as good. So, and most of them are more expensive. So, our fees are gonna be less than $500 a year, annual account fee. And there's a cost to it. We don't have like an asset under management thing. We're not managing the money. There's no percent or anything like it. It's just a flat fee, $50 when they buy or sell. So whoever you're using, there's some cost to that the account owner will incur. So, but then our team is going to take that call and be like, all right, so where's your money at? Okay, it's over at XYZ Credit Union, or it's at Vanguard or whatever. And then we'll make sure we get the right account set up so the funds get rolled over and then get it invested into the deal. And I'd say that can take 2 to 3 weeks. It can take a week, depending on where it's coming from and how fast and active this account owner, investor is in signing documents. So it's all electronic. They can e-sign their documents with us, and then we coordinate with where their money's at to move it over. So we're regulated like a bank. So we have the banking department that examines us here in the state of Arizona, but we do this nationwide. We have annual audits by RSM. They're the 7th largest accounting firm in the world. We have financial audits too with Hinton Burdick, another big accounting CPA firm. It's like we're kind of highly regulated, as we should be. But I just want you guys to know that it's like we're not just like some LLC out there, somebody that's like, hey, we want to do self-directed IRAs, and I set up an LLC in 20 minutes online.
I bought a $97 course on YouTube that taught me how to do this.
No. So we have a team of lawyers and CPAs and a well-trained staff, credentialed people, and we take it seriously because we want to make sure it's done right. And but that's good for anybody raising capital, right? You want to make sure these are your investors. You want to make sure they're taken care of. That is, and people have worked really hard to get this money set aside, right? They've been taking this money out of their paycheck or setting it aside to invest and grow for the long haul. And so we want to take it seriously and make sure that it's done right when it comes over to us.
100%. There's 2 things I want to touch on that I think are really important. One, that 2 to 3 week window. Because for those that are raising capital, you need to be aware of that. If you're trying to raise capital next week, like you need to be having this conversation ahead of time. And that's where we believe in a lot of just constant nurturing and education. If you're constantly talking about this, if you're constantly sharing this information with your network, they'll be aware of it. So that way the money's there for when you need it. So that was point number 1. Point number 2, you mentioned a rollover. So I want to touch on that because one of the questions we've gotten is, well, I don't want to pay any penalties. I don't want to pay any fees. So speak to that a little bit.
So let me walk through the typical things you'll encounter with an investor of where their money's at now. I think that's probably the best way to do it. And this is like the critical question, because it's like, I've talked to someone, I know they have money in an IRA or 401k. I know they want to make the investment. Okay, I'm going to send them to directed IRA. Where could that break down? Where could be a problem where it's a penalty issue or there's a problem? If they're in an IRA, any account that says IRA at the end of it, you're fine. Traditional IRA, SEP IRA, Roth IRA, that's easy. Because I'm just going to set up a Roth IRA at directed IRA and we're going to transfer the money over, the whole thing or a partial amount. It's easy. No taxes, no penalty, no consequences. Just like they went from Morgan Stanley to Fidelity, to Vanguard to Schwab. They just changed the custodian of this piece of money for the retirement account. No taxes, okay? It doesn't penalize them at all.
Hey, Dallon here. I have a special invitation for you right before we get back to the show. If you're out there raising capital or trying to, here's the truth. You don't need more calls. You need better ones. That's exactly why we host weekly capital flow workshops. Every single week, we bring in experts who show you how to generate more investor leads, accelerate trust in half the time and pitch without pressure. It's not theory. It's what's working right now for active capital raisers in the trenches. No need to do this alone. Go ahead and click on the link in the description or the show notes below to make sure you don't miss the next workshop. Who knows what new idea or strategy could lead to your next investor. Join us live every week and plug into the flow. Click the link below to join us. And now let's get back to the show.
The tricky one is the employer accounts, like a 401k or maybe a 403b, basically any employer-based account that they've had. And most people are familiar have had a 401k. Now the 401k, I always like the best way to explain this is The Office. Everybody's seen The Office, okay? Have you heard me do this one yet?
I don't know.
Okay, all right. Okay, this is helpful. I think that's because most people have seen The Office. Okay. The rule on 401ks is if it's an old employer, you can move the money. So if I have an old employer 401k, I don't work there anymore, I can always just move that money to a self-directed IRA. If it was traditional 401k dollars, I move it to a traditional IRA. If it was Roth 401k dollars, I'll roll that to a self-directed Roth IRA, okay? And that's easy. And then you've got well, I still work there, but I'm at retirement age. You can also move the money. So let's say I'm 60 years old, I still work at the company where I have my 401k. Well, I can move it still. Okay. The next category, and I'm going to come back to The Office here in a second. The next category is you still work there. If you still work there, your money's locked up. So let's go to The Office now. Okay. The Office, if you remember the show, right? Let's go to Jim Halpert. Okay. Everyone remembers Jim. Okay. In the show, he's like 30 or 40, right? During the show. I'd probably put him in his 30s, I guess, during the show. But he works at Dunder Mifflin. If he's got a Dunder Mifflin 401k and you're talking to Jim Halpert to be like, you want to invest in my fund? And Jim Halpert's like, well, yeah, I want to. Well, he's probably not gonna be able to do it because he's got a current employer 401k. Mm-hmm. And that money's most 401k providers will lock you down and say, as long as you're an employee at Dunder Mifflin in the Dunder Mifflin 401k, we use Vanguard and you're stuck here. Okay. Now let's say you're talking though to, Jan. Okay. Michael Scott's boss, ex-girlfriend, right? Remember Jan? Okay. She quits Dunder Mifflin during the show. She's in her 40s. She was an exec making a lot of money, probably, maybe throwing a lot of it in her 401k. You're talking to her to raise capital. You're like, all right, Jan, you want to invest in my deal? Well, Jan's probably gonna be able to do it because she's going to be able to do it. She has an old employer, Dunder Mifflin 401k. She's gonna be able to roll that to a self-directed IRA and invest in your deal. Okay. Now let's go to the next one. Let's say you're talking to Creed. Okay. Remember Creed or Meredith in the show. Now, I don't know you want either one of those as an investor in your deal, but okay, let's say you're talking to Creed and you're like, all right, Creed's like, all right, I want to invest in your deal. But I work at Dunder Mifflin and it's my Dunder Mifflin 401k. Well, Creed's over 60. He's actually, even though he still works there, if you're over retirement plan age and in a current employer 401k, they have to let you roll it out to an IRA. So he's unlocked, and Meredith would be too. I think she's got to be over 60 in the show. Maybe not, I don't know. But so Creed could roll over to a self-directed IRA, directed IRA, and then invest in your deal. So the ones that get stuck is the Jim Halperts, okay? They're 30, they're 40, it's still the same 401k. But you run across a lot of people that are like, oh, well, I worked at XYZ company, I'm 45, and my 30s, I worked at XYZ company for 10 years. I got 150K in that old employer 401k. And I got another 150K at this current employer 401k where I'm at. Well, that old employer 401k, you can move to an IRA. Even if you rolled that prior employer 401k into your current employer 401k, they still can't lock that down. So those dollars you can trace and even roll those out to a self-directed IRA.
Wow.
So learn how to access this is helpful. I just want to get The Office as an example because the 401k can be tricky. My team can help if that was confusing and you're like, I don't know if this person can use this money or not. But
yeah, and I want to highlight that again. Like if you're not sure, reach out to Matt's team. Like that's exactly what they're there, and they'll get that person on the phone. They'll ask the right questions and be able to guide them along that journey. For those that are federal employees or they have some sort of pensions, is this something that they could take advantage of?
Yeah, absolutely. And they're going to kind of get into that same thing, or is this an current plan? So, you have like TSP plans and 457 plans and stuff like that. Sometimes you have the 403Bs as well that I mentioned earlier. What I was saying about the 401k is basically the same thing. it's the same rules of, is it your current? Are you still working there? If you are you retirement plan age? Then you can use it and roll it. But again, if you're the Jim Halpert working at the federal government or state government, they'll likely lock you down until you leave or hit retirement age.
Makes sense. We've talked about a lot of great things and exciting things about self-directed IRAs. What would you say are some things for people just to be aware of, to be considerate of, before they just jump both feet in? Like, what are some of those frequently asked questions or things that maybe come up that people are like, oh, well, I didn't know that, or I wish I knew that before?
Yeah, I think some people, what I just tell people typically is self-directing your IRA is not rocket science. It's more like playing a board game. But just like a board game, there are some rules to the thing, and you do need to know how they work before you start moving all the pieces and start, rolling dice and stuff. So just kind of get up to speed on the rules. And there's a couple ways you can do that. One, you can read my book. I wrote a book on this.
That's the only one.
That's the Self-Directed IRA Handbook. We have a podcast, the Directed IRA podcast. That's all we talk about. Me and my partner, Mark Kohler, 2 tax lawyers talking about this. If you want to geek out on it, you can listen to that, or just listen to the first 10 episodes, which are really kind of like what you really need to know. Everything else are more deep dives. We have a Self-Directed IRA Summit. Okay, that's April 26th in Dallas, April 26th, 2025, sdrasummit.com. You can go there. And then if you go to directira.com too, just our company website, we have a ton of workshops and webinars. And so just get up to speed on it. But all I'll say about this is you don't need to know everything. If you're just going to invest in a private fund, or that's what you're syndicating, you raise capital in that, just learn those rules. You don't need to know the rules about startups, the rules about crypto, the rules, you know what I mean? Just even the rules for real estate, where we've got like people flipping houses and doing buy and hold rentals. There's lots of rules like, well, if it's your IRA that bought the property, you can't work on it, you can't stay at it, you can't lease it to your kids. When you're investing in a private fund or raising capital, that stuff's usually not there.
Yeah.
So, so I just say a couple rules, but there are probably 2 things to know. I don't know how much you want me to get into this, but there are 2 common questions.
We could touch on it, and then they could go read your book for more context.
Okay, yeah. So let me say that the one thing is there's something called a prohibited transaction, which means your IRA cannot transact with yourself. So for example, if Dallon has an IRA, a directed IRA, and he wants to go buy real estate with that IRA, he can't buy real estate from himself with his IRA, because he's personally selling real estate to his IRA. Congress, when they wrote the rules on IRAs, was like, we don't want you investing and buying and selling stuff between yourself personally and your IRA. And that would include your spouse. If you're in Utah, all of your spouses, okay, your kids, your parents. So it's like certain family members are restricted. So that's one rule called prohibited transactions. And there's 3 chapters in my book on that. That's probably like an hour and a half at the Self-Directed IRA Summit on like how that works and different variations and structures to get around it sometimes, things like that. The other one is something that this is probably more applicable. It could come up. It's called UDFI or UBTI. There's a tax that happens to an IRA when it gets leveraged with debt. Now, a lot of syndicators are going to raise capital and they are leveraging with debt almost always. And so unless you get taxed as a REIT, which is a great strategy to get around this, but most aren't. Let's just say you're a LLC doing value add multifamily. Okay, then you can have this tax called UDFI. Because what happens is when an IRA invests cash and then it goes into a fund that is leveraging with debt to buy assets, like a multifamily fund or even a private equity fund does the same thing, buying businesses, is when those profits come through, the IRS says, well, some of those profits were from debt, not from capital of the IRA invested. And so they kind of do this tax on it. And it's impossible to explain on a podcast, especially right now. But that's probably one thing to get up to speed on, because you may get questions on that.
Yeah.
You might have someone be like, oh, my CPA asked me about this. I don't know. Is that kind of UBTI or UBIT or UDFI? So anything like a U and a few letters after it, that's what this is, all right?
Yeah, just I think stuff to be aware of. And it doesn't, in my experience, it's never been enough to break a deal.
Yeah.
On
Let me
people.
say this on that. And if you that becomes an issue for someone raising capital, go through my analysis I've done on it in some of my longer form stuff, because you only pay that tax if you made a lot of money on it.
Right.
And if someone's going to walk away from your investment because you made them a lot of money, and that means their IRA had to pay tax, I'm just telling you, like that means that they're giving up return it's like they're walking away from a greater return, because otherwise their IRA would just be invested in a mutual fund making what it was making. So because you still get depreciation expense and some write-offs to help offset this tax. So it's hard. It might be a little tricky to follow what I'm saying here, but the tax only applies if they're making a lot of money on the deal.
And the great thing about real estate is there's a lot of tax benefits and incentives too that you just mentioned earlier could help offset this potential
and greater
tax
return
as well.
potential, because you can leverage with debt.
Yeah.
You can leverage with debt to get a greater return. I mean, that's one of the reasons real estate provides such impactful returns.
Awesome. Matt, this was incredible. And and as we wrap things up, when you look back on your journey in serving people through self-directed IRAs and investing using them yourself, what's one thing that you know now that you wish you knew then when you got started?
That's a good question. One thing I've been focused on a little bit more is time management. And I've been pretty good at it. I'm going to give 3 tips out here. Let's see if I can give 3 tips. This is the first thing I learned. And even driving over here today is a good example. I listened to a podcast on my way over here. One of the executives in my team was talking. He was like, "How do you know all this stuff that's going on?" And I'm like, "I don't know anything that's going on in the world of sports. I don't know who's in the Super Bowl. I do now because my mother-in-law was in. She's a Kansas City Chiefs fan, but I had no idea who was in the playoffs were here. I don't know. Okay, I have Suns tickets. I have not been at all this year. Okay, so like I like that stuff, but I really don't spend my time doing that stuff. So if I'm in my car, I'm learning, and I'm listening to podcasts, weird podcasts most people don't listen to. I'm not listening to a sports podcast. I'm not into politics. The election just happened. I'm not into it. I know people are so passionate about politics and there are consequences to it. Don't get me wrong, but I'm focused on riding the surfboard.
Yeah.
I'm not focused on the wave and trying to control it and my little piece in it. Some people are. I don't mean but for me, I'm focused on the surfboard, and that's what I'm learning and what I can do. So I'm just so spend your time where you can learning. If you're busy, an entrepreneur, whatever you are, I think you've got to get those moments to still learn. And I learn a lot just from podcasts. Okay, so that was one tip. The second tip, and this is one that you have to moderate, is I'm always like, I better be doing something while I'm doing nothing. Okay. And so that's a quote from Napoleon Dynamite. So might as well be doing something while you're doing nothing. If I'm standing in line of somewhere, I'm returning an email. If I'm like, and I try to be careful when I'm driving my car, I'm multitasking a lot. All right. But now there's issues that I got in my personal life, because I'm like, dude, are you like here? Are you present or not?
I think that's one of the biggest struggles as entrepreneurs.
Yeah, because you got to clear your mind sometimes. And so I'm working on that. But there are a lot of times where it's like, I need to be doing something while I'm doing nothing. I'm on vacation last week, What do I do on vacation? I'm reading stuff. I'm strategizing stuff. I'm writing stuff out. That's fun to me, actually. Mm-hmm. But it's like, I call that my work fun, But that's what I'm doing when I'm on the beach. I wanted to read a novel. I just couldn't, I was like, I wanted to absorb some of the stuff in planning and strategizing for my business. So like, do something while you're doing nothing would be another tip. And I don't know if this is the line of stuff you wanted, but I'm giving it anyways.
This is great.
Okay.
This is great.
All right. Oh, I had a third one that was my third one. This is okay. All right. The third one is, what is your ROH, your return on hustle? Okay. Mm-hmm. A lot of people talk about your return on investment and ROI, but your time becomes really your ultimate limitation in many things, because you got a lot of stuff you want to do, a lot of places you want to be. You got spouse or family or whatever it might be, competing, friends, relationships you're trying to keep. Those are all valuable. So when it's work stuff, I'm calculating what is my return on hustle. So a lot of things like investment opportunities, I'm an investor myself. I look at certain things, I'm like, that's a great investment, not worth my time though. So like I've been investing in some things. I just made a few new investments just this last week. And some of the stuff I'm like, that's too much time for me to diligence and look at that deal. It's a $100,000 investment. I do not have time. It sounds great, and I could probably make some great money on it. Maybe I won't, but my return on hustle to figure that answer out is not worth it. And And so, but there's a lot of things just in your business. And I think people get distracted by that and they don't calculate how much work is that going to take and what is that going to return to me. So always be thinking about what's your return on hustle. I'll give a quick example. And this is hard if you're a high income earner, you're a physician, you're a business owner, you're some professional that makes money, and you're out there trying to buy single family rentals or flip a house on the side, you're doing it wrong. Stop doing that. You will make more money by trying to grow your business, serve more patients, more customers, or whatever you do that's a high income earning thing, and go let that money invest passively.
Yes.
And so, but I think a lot of people get this vision of like some, but this is passive investing.
There's nothing passive about
a rental property. Careful with that. Like, I'm not doing that anymore. I have what I have. I'm having, but I'm not going to go buying more of that. Yeah. It's not a good return on hustle for me in that. It's detracting from this. It's like my law firm partner, Mark, because we debate this, and we have podcasts together. He loves work. He has a bunch of short-term rentals and he loves working on them. They make money. They're great. That's what he does on the weekend. Now he knows though, that is a waste of his time and it's better off that he would use it somewhere else. But for him, he's like, I love putting on a tool belt and going and working on it. It's freaking therapy.
Yeah.
So if that's what it is for you, cool. But know that is not a good investment. Your time would be better spent doing something else. Anyways, a little bit of a rant there.
No, that's great. And it's all related to time management. We all have the same 24 hours in a day. Why is it that some people are able to get so much more done than others? And it's because of those things that you shared. They're learning. They can't sit still. I know for me and for Paul, it drives our wives nuts when we're on vacation. And it is something that we struggle with as well, is how to be present, because it's constantly just thinking of how we can improve, how we can better serve our clients. And it's, there's a lot to that. And I'm actually glad you went down that path. It wasn't at all related to, I guess it tied into self-directed IRAs, because you get your money working for you. That's a good return on hustle. And there's actually a canvas in my office, and the quote on it says, you can't have $1 million dream with a minimum wage work ethic. So you've got to work hard, but how are you investing that time? How are you investing that money? And you put those things together and be consistent, and it's going to pay off. So, Matt, this is an absolute pleasure. Thanks so much for coming in and volunteering your time to us and to our listeners. And listen, if you guys haven't checked out Matt and his YouTube channel, make sure you go there. They put out so much content. And you mentioned earlier, you said lawyer and tax. Like, to most people, they're like, I don't even want to tune into that. You and Mark do a phenomenal job keeping it energetic, keeping it fun. And you can't stop. Like, once you start hearing this type of content, your mind gets opened up to this whole new world. So really appreciate you coming in and sharing these nuggets with our listeners.
Okay. Thanks so much, Dallon. Thanks, Paul. Appreciate it. And I'll have me back. And I need to have you back on our podcast too. But it's a pleasure being here.
Absolutely. And to our listeners, again, if you're looking to raise $100,000 or more, this is the podcast for you. We bring in plenty of guests just like Matt that are raising money or serving others to help them raise more capital in real estate. We'll catch you on the next episode.